Hi, welcome to your home ownership journey, the roadmap to successful home ownership. Today we're going to talk about reverse mortgages. So first of all, what is a reverse mortgage? Well, a reverse mortgage is basically the opposite of a forward mortgage. So all of the traditional loans you've had your whole life, conventional FHA, VA, USDA, whatever kind of loan you did, or you're required to make payments every month is what we would call a forward mortgage. So reverse basically is the opposite of that. You start out with a smaller loan balance in the beginning and monthly payments are not required. So you accrue interest every month that you do not make a payment and your balance increases over time. So, and hopefully if the market performs like it has historically, you will still always have a little bit of equity in your home. So as your balance increases, so does the equity or the value of your home. Hopefully there's always a little bit of a gap there. What are the qualifications for a reverse mortgage? So it's very different. On a traditional loan, we're looking at your credit score, income, debts, down payment to determine how much you can afford each month and what your payments are going to be. This is different. This is based off of your age and how much equity you have in your home. So typically these loans require you to be 62 to be eligible. There are some states and some products that will allow you to do this at 55. So check with your lender, see if that product's available in your state. But assuming if you start out at 62, they're going to let you borrow a certain percentage of the total value of that home. We don't really look at income on these, however, they will. So the income isn't the qualification for these loans, but they will look at some income just to ensure that you can pay your property taxes, insurance, HOA dues, and maintain the property. So that's the other part of the qualification. You are required to pay your own taxes and insurance, HOA dues, property maintenance. If those aren't paid, they can foreclose on you. So this is what's called a non-recourse loan, which means they don't foreclose on you for non-payment. That's basically one of the big benefits of this loan. However, there are still bills associated with the property that need to be paid. And if those aren't paid, then the bank can start the foreclosure process. It also needs to be your primary residence. So you have to live in that the majority of the year yourself. You will sign an affidavit every year confirming you're still using the home as your primary residence. Now, that doesn't mean that you can't have other property or a second home or any of those kind of things, but the home with the reverse mortgage on it does need to be your primary residence. We can use these loans for a refi or a purchase. Probably the most common way is to refi a home someone already owns. And you can refi and pay off a current loan. Say you have a forward mortgage and you don't want to make that payment anymore, you can refi it into a reverse and no payments are required anymore. If there's enough equity in the property, we can also take cash out and we can structure that a few different ways. You can do a lump sum, you can do a monthly stipend, you can also set up a home equity line or a combination of those things. So it's a really cool way to access your equity if you want to. We can structure that multiple different ways. You can also use it to purchase a new home. A lot of people don't think about using these loans for a purchase, but you absolutely can do that. You're just bringing in the down payment based off of what your age allows your loan to value to be. So there's a lot of myths about these loans. First of all, I want to say they're not a scam, just like any other loan. Maybe they're not for everyone. But the bank is not trying to take your home with these loans, which is what a lot of people think. Really what this loan was intended for was to help people who are no longer working and need to either supplement their retirement or can't keep up with that payment for whatever reason. Say you were, you were married for years and you had joint income, and then something happens to your spouse, and now you're down to a single income. You want to stay in your home. This is a great way to do that with using your equity. For most Americans, their home is their biggest asset, and you worked for years to pay that down. But you can't tap into the equity you have unless you borrow it or sell your property. So this is a great way to use this loan if you want to, for staying in your home. This loan isn't just for people who are tight on income. There's a lot of ways that people use this loan, but it was created to help people stay in their homes. So like I mentioned before, it's a non-recourse loan, so no payments are required. There are some ways that the bank can foreclose on the property, so be aware of that. You still have to maintain and pay the other bills associated with it. A lot of times people are surprised when a foreclosure notice is given because they haven't been paying their taxes or something like that. So just make sure that those bills are also paid. Another requirement for these loans is the borrower has to take a credit counseling class before you can even apply. So they really want to protect the borrowers and have made a lot of changes over the years to protect borrowers and make sure that they understand what they're getting into with these loans and aren't being taken advantage of. So what happens to the property when the borrower no longer lives in the property? Either they need to move or can't occupy it as their primary residence for the entire year, or they've passed away. A lot of times people think this is where the bank comes in and just takes the property back. That is not the case. You will work with the lender, the heirs of the estate, or even the homeowner will work with the lender to either sell the property or pay off the balance. Hopefully they have gained equity, even though their balance has increased, and you go sell the property just like you normally would, and you pay off the lien when the house is sold. Whatever equity you had is paid to you or your estate. Or the heirs of the property can also try to refinance that if they're not eligible for another reverse mortgage. Whoever inherits the property can refi it into a regular forward mortgage if they qualify, or pay off the balance. And if something happens, say the worst case scenario happened and the house was upside down in its value, so they own the balance was more than what the property was worth, then the bank is not going to go after the estate for the balance. Part of what you pay in the closing costs of this loan is mortgage insurance. And what that mortgage insurance is doing is insuring the lender for that very reason. So if they are upside down, you're not going to get a bill, or the estate's not going to get a bill from the lender later on. If that is the case, you can still try to sell the property and clear it up that way, or that is where a scenario where you can just let the bank have it. Now they're not going to want to do that necessarily. The banks don't want to be property sellers, but that is an option. To wrap up, these are a really cool loan. Like I said, just not necessarily for everyone, but if it's something that you're interested in, if you need to tap into the equity of your property and you're 62 or older, they can be a great way to do that without increasing your monthly outgoing expenses. So don't be afraid of these loans. As always, I'm happy to chat with you about your scenario, see if they're the right fit for you and your family. If you're in a position where your family is starting to help you with your finances, I'm happy to talk with the whole family, make sure everybody understands how these loans work, and that we're not doing something to take advantage of your parents or your grandparents. So as always, reach out if you have any questions, and I will talk to you soon.